All right, today we're tearing into the IPO prospectus of a company with some truly eye-watering numbers. This is INDO SMC. And let's be clear, our job here is to give this a brutally honest, rational, fact-based evaluation. No hype, just the hard facts.
Okay, so let's get right into it. We're looking at a company that's barely 4 years old, and it's reporting profit growth of over 3,000%. Now that's the kind of number that grabs headlines, right? But for us, as serious investors, it also raises one huge question. Is this incredible story for real, or is it just plain too good to be true?
So before we get completely lost in those crazy financials, let's bring it back to basics. We've got to understand what this company actually does to make money.
Basically, INDO SMC has its hands in three main pots. First, they use something called sheet molding compound to make enclosure boxes for energy meters. Think of it as the tough little shell for all those smart meters popping up everywhere. They also make fiberglass products for industrial use. And finally, they produce other electrical bits and pieces for power grids. Now this is key. Their business model is all about selling to other companies and, more importantly, government utilities, often by winning competitive bids called tenders.
All right, now for the main event, the part of the story that's really driving this IPO. Let's look at the explosive financials that have suddenly put INDO SMC on everyone's radar.
So let's set our baseline. If we rewind to the fiscal year 2023, the company's revenue from operations was sitting at just under 730 lakh rupees, a respectable number for a small company.
Now fast forward just 2 years to fiscal year 25. That revenue number, it hasn't just grown, it's exploded. We're talking nearly 14,000 lakh rupees. That's about a 19-fold jump. This isn't just growth, folks. This is a rocket launch.
But hey, revenue is only one part of the picture. The profitability story is, believe it or not, even crazier. Between fiscal years 23 and 25, their profit after tax shot up by 3,290%. This shows it wasn't just about selling more stuff. They were actually making serious money on it. It dropped right to the bottom line.
This table here really lays it all out. Just look at that revenue growth, accelerating to almost 400% in FY25. And check out the profit margin. It's actually getting better, jumping from around 6% to over 11%. But the real head-scratcher is the return on equity, or ROE. Look, anything over 20% is considered fantastic. These numbers are just off the charts. Which brings us back to that big question. How in the world can any company possibly keep this up?
Numbers like that don't just appear out of thin air. So, what's really propping all of this up? What are the company's underlying strengths? And, probably the most important question of all, is any of this defensible? Do they have what we call a competitive moat?
If you peek into their own analysis, a couple of things really jump out. A strong order book and, bingo, favorable government policies. This right here, this is the engine of the whole growth story. Huge government programs have created this massive, hungry market for their main product, those smart meter boxes. They were just in the right place at the right time to catch this massive wave. But, and this is a huge but, here's the reality check. And it comes straight from the horse's mouth, right from their own prospectus. They say they operate in a highly competitive and fragmented market. You know what that's code for? The exact opposite of a strong moat. It means there are a ton of other companies doing the same thing, and the only way to win is often on price. This tells you everything you need to know. Their success is tethered to a government policy wave, not some unique, untouchable advantage. And that brings us to, honestly, the most critical part of this entire analysis. We've seen the dream, now we have to talk about the dangers. It's time to shine a bright light on the red flags every single investor needs to be aware of.
Just take a look at this timeline. The company was officially born in late 2021. So by the time this IPO hits, it's barely been around for 4 years. We're not talking about a seasoned company here. We are, for all intents and purposes, talking about a startup. And that short a track record, that is a massive risk factor all by itself.
So you see the conflict here, right? It's a classic tale of two stories. On one side, you've got this incredible, explosive growth, a fat order book, and an IPO where every penny is going back into the business. That's the promise. But on the other side, you have the peril. The growth is almost completely hooked on government whims. The company's brand new, and they're fighting in a crowded market with no real defenses.
This forces us to ask the same tough questions any professional analyst would. I mean, seriously, is 400% annual growth sustainable? What's plan B for when these government programs inevitably wind down?
Are they too dependent on just a few big customers? Is there any real moat here? And can a management team this new really handle this kind of insane growth without messing up? And of course, what are the extra risks that come with an SME listing?
Okay, let's pull all these threads together. Let's translate all this analysis into a simple, clear, bottom-line verdict for you, the investor.
First things first, and this is super important. This is an SME IPO. It's not listing on the big board. For a regular investor, that means a few things. Higher risk for sure, but also lower liquidity. That's a fancy way of saying it might be really hard to sell your shares when you want to. If things go south, you could be stuck. It's a whole different ballgame, and it's definitely not for the faint of heart.
Now on the flip side, here's a big positive. This IPO is a 100% fresh issue. What that means is the original owners, the promoters, aren't cashing out, not a single share. All the money raised is going right back into the company's veins to fund its growth. That's a great sign. It means their interests are aligned with yours.
Of course, the elephant in the room is the price, the valuation. We don't know the exact number yet, but come on, let's be real. A story this hot with numbers this crazy, it is going to be priced to perfection. The merchant bankers are going to make sure of that. So the biggest risk for you as an investor is simply paying too much, buying in right at the peak of the hype.
So who should even be looking at this? Let's cut to the chase. If you're a safe, conservative investor, absolutely not. Avoid. If you're a moderate risk taker, I'd still say avoid. The risks are just too specific and too high. This one is only, and I mean only, for the high-risk, aggressive investor who fully understands they're making a highly speculative bet.
So our final verdict is pretty simple. It's neutral, but leaning towards only for high-risk takers. For most people, it's a pass. The story is amazing, no doubt, but the ground it's built on feels pretty shaky. It's all resting on temporary government policies and a very short history.
And that really leaves us with the one question that matters. Are you looking at a future multi-bagger, an investment that could be a huge winner, or is this just a policy bubble inflated by government spending that's just waiting for a pinprick to burst? That is the multi-million-dollar question you have to answer before putting any money down.